at this rate, but also at this rate of adoption. Like what happened yesterday, $12 million investment from two very high-profile VCs is going to signal to entrepreneurs everywhere that I should start looking at a decentralized network effects business model.
Welcome, listeners. Today we're here with Jonathon Kroll, MBA student at Cornell Tech. And we have a lot of exciting stuff to talk about today, about the future, about cryptocurrency, and much more. So Jonathan had some stuff planned for us.
Thanks, Brett. So this is awesome. This is my first podcast ever. So you've taken my podcast virginity of sorts.
Awesome. I've been racking them up.
I can tell by the looks of this place.
Yeah.
No, so this is great. Thanks for having me. And I just really like this idea of just having a free-flowing conversation about all the exciting stuff that's happening.
Definitely. Happy to have you here. Yeah, so you're talking about CryptoKitties?
For those who don't know about CryptoKitties, CryptoKitties kind of took the blockchain world by storm like last November. It's a way to use the blockchain to not only transfer assets between two parties, but to also create new assets as a combination of those assets. So that's what we would call mating for cats. But this is really like a proof of concept of what's possible. And it exploded. It grew to encompass a huge percentage of the Ethereum mining network's capacity. It is still a big part of that, or a big chunk of that today. But everyone kind of wrote it off as a fad. Like this is just the first big proof of concept of what you can do on the blockchain in terms of gaming. And there are rare kitties. There were folks who made hundreds of thousands of dollars by breeding or by buying a rare cat. So that kind of fervor has died down a little bit. But what's interesting is that this was not just a way to make digital cats. You could do that without the blockchain. It'd probably be a lot easier because there are a lot of copycats now. No pun intended, actually.
Crypto copycats?
Of CryptoKitties. I mean, right away there were crypto pups, there were crypto robots. There's all kinds of stuff now. Now you can go buy a version of the Queensboro Bridge digitally and own that, and then hope that goes up in value. Yeah. Because that's, you own the one digital version of that from that one.
And that's all Ethereum based, or is it just everywhere? Okay.
This is a category of app called decentralized apps, or dApps, basically. You're going to see that term a lot this year, I predict, because this is now moving from the fringes and the bleeding edge to more of the mainstream. Because yesterday, there was a big signal that this sort of platform and business model is legitimate enough for real investors to get involved. We're not talking like the scam ICOs. What happened yesterday was Union Square Ventures, Fred Wilson, and Andreesen Horowitz teamed up to invest $12 million into CryptoKitties. And this came out of nowhere.
Oh, and just into CryptoKitties?
Just to spin CryptoKitties out of its current company. It's kind of like a development shop where they do internal products and spin them out. And that's what CryptoKitties was. So now it's going to spin out to be its own thing. That is big news. While it may look like it's just a very strange investment or kind of a fun investment from a VC, what I see is that this is big validation that some of the best investors in the venture world see enough value in the decentralization part of the business model and the network effects that creates to invest a significant amount of money in something like CryptoKitties. And there must be extremely, extremely exciting future plan for what that's going to become and how that's going to be the kind of genesis of a new way we transact, a new way we transfer assets, and a new way we basically keep track of things which right now require middlemen or software or just other types of processes. And this is a big step forward for that. And I was not expecting that.
So do you think they got their own CryptoKitties in the transaction? Think they got some specially that'll increase in value? Think they get an A16Z CryptoKitty?
That's a great question. I'm glad you asked. So that's part of having a decentralized app on the blockchain governed by a smart contract. It would be hard for them to just give them special cats. Now, I know that they release new traits, they release new genes. They make those available at a certain time. Players of the game who are not really players, but they own these digital assets, which CryptoKitties, will discover these. They'll be breeding cats, and then lo and behold, you'll breed a whole new breed of cat, or some crazy fancy cat that looks like an alien that's also like an alien or a ninja, or some kind of Santa. This stuff, I'm not making this up. That's awesome. But those become extremely rare, and so that's more of an incentive for people to keep
it's like a Pokemon cards for digital assets.
Exactly. So it would be very difficult, if not impossible. I'm not an expert on the smart contracts part of this, but the smart contracts is what governs this entire thing. Think of the blockchain like a really just stupid technology. It's like a notebook, a ledger. But the person writing down, historically, transactions in a ledger is a skilled accountant. So a smart contract is the logic to the blockchain that makes the blockchain applicable to so many different use cases and industries. And that's really exciting. They really couldn't even give Fred Wilson special kitties.
Right, unless they already had them or something.
So he does have them. They could say, Fred, we're releasing this gene. This kitty you have here with this kitty here. It's a high likelihood that you'll get some crazy kitty out of it.
Are they the only ones who have access to that, say, like the smart contract and how the kitty's made, or is that also available and decentralized to the public?
So the smart contract is available to the public, but in terms of how they release new genes or when that's decided, or if there's a release schedule of that was decided a long time ago and is built into the smart contract, that's something I don't know, because that's beyond my skill level in terms of understanding this stuff. I've really had a lot of fun, though, experimenting with this decentralized applications. Right now, they're not much. It's like CryptoKitties, all the CryptoKitties, copycats, and they're basically, and some of them are Ponzi schemes. Like there's some that are like crypto countries. It's like you buy the country, buy the Philippines. Okay, so the next person who buys it at a 15% markup that's built in. But then after that, you keep getting like 1% of the royalties. So at a certain point, somebody's stuck at the bottom. Those are just Ponzi schemes.
Right.
There's also decentralized betting. Like there's all kinds of Ethereum lottos and blackjack and dice and those types of games, which are probably legal in the United States, but they exist on the blockchain, which is, again, interesting, but not really a useful use case, since lotteries here in the U.S. are regulated so heavily that the blockchain wouldn't help ensure any fairness. That's what the whole lottery does itself as an organization. The other categories of decentralized or decentralization go more towards actual mature types of implementations of this technology. So like decentralized file storage. So Dropbox, instead of Dropbox having your stuff on a bunch of AWS servers somewhere in the world, of course, like spread out amongst those. Your files would be spread out amongst my computer, your computer, anybody who would be participating in this network. So that's one example of a real use case. Another one that I'm actually find really interesting is smart bonds. So think about a municipal bond or a corporate bond. As a financial instrument, it's pretty much cut and dry. You know exactly what you're going to be returned each month in terms of a payment. You know the face value of the bond. You know how long it's going to pay you for, and so on and so forth. And then at a certain point, it stops, or somebody buys it. So that's a perfect use case for a smart contract. And not only that, the smart contract then removes the need for, a clearinghouse to make sure that these assets actually change hands.
And so does that, for right now at least, is that just being paid out in Ethereum coins, like in Ether, or whatever, like the coin is built on top of Ethereum? You can't do that with cash right now, could you? Or
you cannot do it with cash. So that is the distinction. So the blockchain, the Ethereum blockchain, that's really what Ethereum is. It's the blockchain. It's just that ledger. The cryptocurrency that's tied to the Ethereum blockchain is called Ether. And if you've heard of ICO's initial coin offerings, those are almost always crypto tokens that are issued according to the standard, which means they'll be on the Ethereum blockchain. So the Ethereum blockchain has become the standard for all of these tokens, just the tokenization of services, of goods, and also just tokens for the sake of tokens.
Right.
Actually, to have a decentralized app most of the time there's a token associated with them.
Right, and can those tokens convert to Ether, and that's like a central thing, or they're separate?
That's separate. So there's exchanges. So not all the tokens are traded on an exchange. It's interesting because like we have in the public markets like the New York Stock Exchange and the NASDAQ, and there's those smaller markets. But that's it. That's the stock market. When we say the stock market, that's it. But imagine if the stock market was fragmented and it was like this little market here in LA, this one here in Seattle, this one here in Chicago, this one here in Dallas, this one here in Omaha, this one in Guam, and none of them had clear and away majority market share. So you had all these little fragmented markets, each of which was a little microcosm. It had different pricing, it had different volume, different participants. That's what we have now. So especially in terms of these are called altcoins, like the alternative coins. Especially with those, they're not listed everywhere. Sometimes one obscure exchange will list this one coin that you would want to buy. And then you have to figure out a way to get that back to like your main exchange if that's what you want to use. But for the main cryptocurrencies though, those are still concentrated amongst multiple cryptocurrency exchanges. So the most well-known one to lay people would be like Coinbase, because that's also a company Fred Wilson has invested in. So there's some vertical integration in some way here. Fred Wilson is an interesting sort of proponent of this technology. He doesn't believe in it fully, but he believes in the underlying theory of it. He has said there will be some kind of correction. There'll be a crash, there'll be a bubble in a similar fashion to what happened in the dot-com bubble. Because right now, we are seeing rampant speculation. The ICO stuff is absolutely insane, and it's totally unsustainable. And it's illegal now in the United States. But you're really selling junk. So these utility tokens, they're called, that's the token you're buying for an ICO. It doesn't entitle you to any of the equity. So you're not really investing. You're investing in the token that allows you to use the thing. So it's like if you went to Chuck E. Cheese and got tokens, that's what you're buying.
And just like an arcade.
Exactly.
Crypto arcades.
Exactly. So it's purely speculative it's just speculation that's driving those up so high. So Fred Wilson knows that stuff like that is going to stop, and stop pretty soon. Now there are other tokens called security tokens or asset tokens, which the SEC is totally open to regulating and are going to entitle the holder to have equity just like you would if you bought a share of stock. But the problem is that's really now no different. It's not going to be
the same as
exactly. Yeah. So an ICO will be just an IPO, but just using a coin instead of a share of stock.
Saved on a ledger as opposed to on like a centralized bank or something.
I think it would go through some kind of third-party clearinghouse to clear trades in the public markets. But so whereas JP Morgan would underwrite your IPO, that remains to be seen who would be underwriting the IPOs, so to speak, of these companies, because you need that financial backer. That's if this does become a new way to IPO. Because the ICOs, interestingly enough, they're not initial offerings like you'd think it's an exit. It's like very much an entrance. A lot of the time, these are pre-revenue, pre-product startups.
Like a seed round.
Yeah, and that's why they're scams, because nowhere else can you raise $35 million in 11 seconds and actually own 100% of your equity at the end of the day. Like, you see why it's a scam, because they're just playing into the fervor and the get-rich-quick craziness that has saturated that world. But so that will blow up. There's no way that's sustainable. Yeah. The question is how it gets put back together afterwards. And so that's what people like Fred Wilson believe is going to happen, and it's going to mature. And that's why yesterday was a very, very pivotal day in that, because it's just another sign that this technology has merit.
So how many CryptoKitties do you own?
Probably about 30.
Nice.
I tried to sell lots of them. It's very hard. They're very hard to sell them. So what I've actually tried to do now is figure out how to breed the ones that are rare, but that takes a lot of time, because there's actually a genome for this stuff. There's people with, I don't know where they get this much time, but they've mapped out the kitty genome, and they know what is what and what's going to create what. So I really have just been experimenting with it as a way to understand what it's like using a decentralized app right now, and what that could mean in the future. I'm trying many other ones besides CryptoKitties. CryptoKitties is kind of like the one that broke the seal back in like December. That's when they were really hit its like peak popularity. There's now a whole slew of decentralized apps that have come online, and I've been playing around with some brand new ones, and to see different sorts of applications of this technology. And most of them, at least the ones that are not meant to be companies, they're more like projects. Most of them are just like pretty worthless. There's others though, other companies that are looking to decentralization as a way to run things like an entire city, for example, for a way to actually disrupt the way the equities markets work, who are actually backed by real people. And these are not folks who are coming in and getting into the hysteria of this, but they're looking in the long term, or trying to play towards the long term maturity of this technology. So there's two sides right now. The hard part is when I start to research the folks who are trying to make this a mature technology, it's still so complex. Even understanding what they're doing takes a long time. And it takes me a couple of reads of all of their white papers, of their websites. I understand what it is they're trying to do and why that's a value add. It's a very complicated and esoteric world. There's actually a whole vernacular that you need for this stuff. It's like you can't just buy your ether and then that give me ether. You know, you need a wallet. You likely need, that means likely MetaMask, which is the gold standard of that.
Yeah, I just got that the other day.
And then you have probably seen gas.
No.
Oh, yeah.
What's that?
Gas is you paying for the transaction, you paying for the verification of your transaction. And that is the other side of the... So blockchains don't work without the network behind it. And that's the decentralization. The decentralization is people with computers all around the world who are being compensated by mining. You know, you've heard of the term mining. So what mining actually means is, while I'm looking for new coins, that's not what I'm actually doing. What I'm doing is my CPU is actually verifying transactions on the blockchain, and hopefully GPU if you're mining, because it takes a lot of power.
Right.
That is growing exponentially as the blockchain is adopted more and more. The amount of mining has to increase, because that's the one limitation. CryptoKitties actually really put a huge strain on the Ethereum network when it came out, because it was an overnight success, and it put such a much larger strain on just that its processing capabilities, and it really almost brought it down, which is kind of frightening. But that shows you how important the miners are, and the mining part of it is, which to me means the scarce resource of the future is not cryptocurrency or anything like this, but it's energy. It's electricity. This stuff takes immense amounts of energy, especially as computers get faster. They pull more energy. And when your computer's on 24/7, or you have a farm of computers just because you're a miner, this is not a category of computer use that existed in the mainstream, or not even 2-3 years ago. It was still pretty relegated to like smaller circles who were very early adopters of this sort of technology. And the more miners there are, the more processing power you need to even make a little bit of money. Before, it was like wide open. It's the same thing, same analogy as it is in the real world. Like San Francisco gold rush, if you're the first guy to get there, well, odds are you're going to find the gold that's closest to the surface. You don't have to go dig so deep, or like go pan in the creek over there for some gold.
And so how much energy has been spent on CryptoKitty mining?
So it's not how much has been spent. It's actually the relative amount, I think, per day that's being used. So there's a website that will tell you, and this is just for Ethereum. This is not blockchain mining either, or any of the other cryptocurrencies that require mining as well. So the Ethereum Energy Consumption Index. Number of U.S. households that could be powered by Ethereum. 1.5 million. So I'm assuming...
That's like every day that there's enough Ethereum being mined that it could power...
I'm not sure what the unit of time is on that. Oh yes, that's annual. So per year, status quo level of usage. So nothing has changed. You could power 1.5 million homes.
And that's just now.
That's just now. So,
That's crazy.
Country closest to Ethereum in terms of electricity consumption, the entire country of Turkmenistan per year. So it grew. This used to be Myanmar the other week.
Oh, yeah. So, yeah, and it's growing exponentially, like you're saying. So
it is. At this rate, but also at this rate of adoption. Like what happened yesterday, $12 million investment from 2 very high-profile VCs is going to signal to entrepreneurs everywhere that I should start looking at a decentralized network effects business model. Holy shit, if these guys, like very top-tier VCs, think that there's enough merit in it, CryptoKitties to invest $12 million, then there's something there. And they're probably right. So we're going to see now an exponential growth in terms of the number of startups coming out that have this business model, that are blockchain enabled. Like right now, it's still a bit of a buzzword. There are plenty of startups that are using blockchain just for the sake of using blockchain, which actually can make things a lot slower. Like there's no reason for some things to use blockchain. Like if I buy a hot dog from you and you're a hot dog vendor in New York, you better not be in the blockchain because I'm actually going to be sitting there waiting for my hot dog after I send the transaction through.
Yeah. Hot dog's going to get cold already.
That's right. So no hot dogs on the blockchain.
Well, crypto hot dogs that you can make with hamburgers.
That's right.
Different buns, whole wheat. Oh my God.
Okay, wait. We might want to take this off the podcast.
Yeah, we want to.
Because we're going to probably a side project.
Side of fries project. You got the condiments, you got mustard, ketchup.
And then the rare assets, onion rings. The onion ring.
They go around the hot dog?
Just, they're very rare. That's everyone gets fries with a hot dog, right?
Mm-hmm. Yeah.
But not always can you find a hot dog stand with onion rings.
Yeah.
Besides Nathan's.
You get cultural appreciation through the crypto hot dogs. You got like Icelandic hot dogs.
That's right.
That's really good.
Right. So that's just the trading card model of crypto. So much more there, but yeah. So that stuff's not a physical hot dog stand. Should not be in the blockchain ever. But that's a reaction to just this craze. Like you heard of that tea company, Long Island Tea Company.
No, I know Long Island iced teas.
So it changed its name to Long Island Blockchain Company, and shit you not, its stock went up 15% overnight as a result, just because of that.
Wow. And is it even using blockchains or just changed its name?
Just changed its name. So that is an insane indicator of how bubbly this market is and how ripe it is to all come crashing down.
Yeah.
And that's going to be on the side of the cryptocurrencies, not on the blockchain side. Because the blockchain is what has the value and the smart contracts have the value. The cryptocurrency itself is being taken in the eyes of like the layperson to be the core value, but it's really not.
So how do you see this becoming sustainable? Because it looks like you're a big fan of the blockchains, of the smart contracts, that it makes a lot of sense to be decentralized. You're very interested, and you see this investment coming from a lot of investors, like top tier, but there's a huge issue with that, with the electricity consumption. And I know different currencies or blockchains have different amounts of consumption, and some people are trying to tackle it. Like, how do you see it playing out 5, 10, 50 years into the future?
So that's a great question. I mean, that's really what I'm looking at when I'm evaluating these decentralized apps, when I'm playing around with CryptoKitties, even when I'm like looking at the cryptocurrency markets and looking at the other applications of this blockchain technology that aren't just the hot dog cart or the iced tea company. It really comes down to a core set of fundamental underpinnings of blockchain. Or there's these other variables that are critical to its success. So those variables are the fidelity of the network around blockchain. So the blockchain is the miners. So anything happens to disincentivize you from mining Ethereum, which means verifying transactions, and people start to leave that activity, then Ethereum blockchain is in serious trouble. And the problem is all of these decentralized apps that run on the Ethereum blockchain are now linked. So imagine you're all handcuffed to this one big stick and then you get thrown in the East River. Like you're all going to drown unless some guy can like somehow get out of his one handcuff. But so let's say one guy gets out of his handcuff and gets away from this long stick that has everybody else handcuffed to it. That's like the analogy I would think of a blockchain sinking. On all those people handcuffed to it would be all the companies and all of the services and all of the blockchain enabled X or Y that was on the Ethereum blockchain that could not pivot away from it. So it creates a new strategic risk that doesn't really exist these days because there's not a single point of failure that underlies companies that all use one thing. Like, there's plenty of companies that use a single technology or shared technology, but it doesn't absolutely take them out of the equation, out of business, if that goes away.
So you're saying it's like in America, if the dollar was to crash and go out of business, like every company, every person using the dollar wouldn't be able to anymore. It would be like hyperinflation in Venezuela or old school Germany.
Even worse, I think the analogy for the dollar would mean the entire banking system and transacting system came apart and just imploded. So there was no way for you to spend a dollar because the dollar was worthless because the merchant who took the dollar couldn't do anything with it. Couldn't go back to the bank. Couldn't use it in the network of things that comprises the financial system. It's even worse. That's never happened to that degree because that's a complete collapse of a monetary system and likely of a country in that point, because we're talking about the failure of these businesses and of these projects and of all these potentially important uses of blockchain that are fundamentally tied to it. That's my take on that now. I hope that's not the case and that I'm wrong and that there is some way to be a little bit diversifiable and flexible if you're somebody who's doing something on the Ethereum blockchain. That's something I'm researching. I'm not sure about that, but let's say that's not the case. Then yeah, you're joined and enabled by the blockchain, which is what makes you, but it can also break you easily. I see some risks for the Ethereum blockchain in the upcoming years. I mean, scalability of the network is a huge problem. Ethereum doesn't process transactions at the same rate that competing blockchains do. It's a couple of orders of magnitude less per second. That's huge. So that means something like CryptoKitties comes along and it cripples the Ethereum network. That was A, really important to know, and B, a very important thing to fix and mitigate for the future if Ethereum is to be the blockchain of the future. It could be the MySpace and not the Facebook, because it's the first to really have the network effects to not yet critical mass, but to a point where at least entrepreneurs want to build things for the blockchain. And then it's self-sustaining, and the more people will come. Things like huge investments in decentralized apps from Fred Wilson will absolutely help that. The other part of this is decentralization, doesn't happen in a vacuum. It happens because of people. And people don't just do it in a vacuum either. You don't just decentralize somebody's transaction by verifying a part of it, and that's that. You verify a part of it because you get something out of it, and you verify a part of it by using your computer. And your computer uses electricity. So electricity is not it's a finite resource that does not increase in terms of its supply as quickly as these new demands on energy from crypto have been increasing. The demands on energy are increasing exponentially from cryptocurrency. And when Fred Wilson and Andreesen Horowitz invests in a company like this, opening the door and signaling to other entrepreneurs that we want to see more decentralized network effects companies, that's going to then put a lot more emphasis on the blockchain. And that's going to be a much busier place in terms of scale and transaction size and transactions per second, which means more mining is going to happen. And mining is critical. So mining could be the Achilles heel here if there's not something done to upgrade its throughput, which I think there is at the moment, but right now, as it stands, it's pretty poor. So that's something fundamentally would have to change there. But mining could become so prohibitively expensive because there's all these transactions and the Ethereum network is processing them very slowly. For you to get yours done quickly, you have to pay a lot of money. You're going to pay a premium. So that's a disincentive to use Ethereum blockchain for anything if you pay more money to use it. The other part of that is, let's say you, Brett, let's say you are mining Ethereum right now. You're processing transactions and then every once in a while you get a coin out of it. As this is happening and as more folks are mining cryptocurrencies, not just Ethereum, but cryptocurrencies to support their blockchains, as this becomes a much bigger part of our daily lives and it permeates other industries, then it's going to tax so significantly the electricity grid that prices are just going to increase because there's still limited supply compared to the outsized demand. And that's going to throw off the economics. It could be that it's no longer worth your computing power or your time to mine Ethereum because it costs you more actually to do so than you'll actually get back by mining. That is an accurate statement. So as there's more folks mining these coins over time, it becomes much harder to mine an actual coin for yourself, which means that it's less and less profitable over time for miners, whereas the fuel that they need to do the mining is becoming more and more expensive. That's not a good construct to have.
So you see a huge like scalability issue with this. The more people you bring on, the more expensive it becomes, and the slower it becomes as well, and the more costly. How you have to mine it, it costs money, it costs electricity. So that electricity becomes more expensive over time because you need more of it to process and mine. So there's a lot of different angles that all kind of focus in on, can this scale?
Yeah.
Can this be as big as people are hoping it can be?
That's right. So this is interesting because all of the things I just described are requirements for a blockchain to be flourishing. But it could be that decentralization does not truly happen in some parts of the world, because China, for example, could say, well, okay, this is our blockchain. We're going to support the energy. We're going to subsidize the energy cost of it, of mining, or we'll do the mining. You know, we'll create some nuclear power plants specifically for the mining of this, and then this will be the blockchain that's going to dominate. Now, in the US, that would be nearly impossible for the government to do, especially in short order. I mean, it's just to think that the government would be producing energy specifically to run these blockchains, that totally negates the value of decentralization in the first place. That's problematic. I mean, the other thing that could happen is that the companies that have these economies of scale, like Amazon, where AWS is so cheap because they have this scale, because every time they add some new infrastructure, new capacity, it becomes even cheaper. So companies that are so cash rich but have all this capacity for stuff too will likely get involved. Like, I could definitely see Amazon blockchain as some kind of service and something where they didn't want to make any money on it, or they subsidize your mining cost or something, because it's Amazon, just to get the people on.
Via ABS.
Yes, that's
Amazon
right.
Blockchain services.
That's right. I mean, and so that does get around the decentralization in its philosophical sense as well. Like, but that's something that could happen, because otherwise, in the wild, Ethereum takes all of these participants and it needs them to stay in place. If any of them leave, or if anything changes in any one of their specific arenas that's enough to dissuade them from participating, the whole thing collapses. So
it's like a reverse network effect. Like, if people start going away from the network,
yes,
that doesn't make the network valuable, and there's no one to process anything, and it slowly can decline.
It's like an arch. It's like a human arch, right? So if the guy at the top leaves, everybody falls in.
Yeah, the keystone.
The keystone, yeah. The guy is the keystone. Except they're all keystones here. One of them fails, then something better come in quickly to replace it, or it's dead.
Will crumble around it.
So that's why I'm not fully sold, and I think there's actually a whole new class of startups that might serve the problems that are created by this. Because for a company to make a massive investment on the blockchain, or to entirely move their business on a blockchain, they would be otherwise incurring a huge risk to their survivability, even in the short term, by doing so and having no control over how safe the resources are and the network is to make the blockchain happen.
Interesting. That might be some good places to look to invest into.
Absolutely.
The infrastructure behind.
Absolutely. Or energy, honestly. I think
yeah.
I'm assuming that energy production is going to not decline in cost significantly, because I think the best we can do in terms of cost is probably nuclear, but who knows? Mm-hmm. Maybe we figure something else out, or we start to harness energy from plants or from other sorts of sources, or
storage batteries could get.
Or we make solar panels that can collect energy when it's overcast. Crazy stuff like that. That could happen. That's all in the realm of material science. So that, I'm not saying that energy will stay the same. If it becomes cheaper to produce, then that would be at least helps offset this to some degree. But at the same time, utilities are also monopolies. We don't get to choose who provides our electricity.
Cable, yeah.
They're natural monopolies.
Huge monopolies.
They're natural monopolies because they put in a massive investment for this infrastructure, and there's really not room for nuclear power plants, and they can't compete with each other because they're so expensive. It's just created this construct, and it is called a natural monopoly because that's just, it has to be that way to have utilities. And so
you need to decentralize energy sources.
Well, that's right. So once we go to the moon, though, and we can start to directly harness UV rays.
Well, one of my ideas was to get a really long wire and attach that to the sun, and then you just get all the solar energy. Doesn't matter if it's cloudy.
I like that.
You just hook it up, plug it in, constant energy.
Sun wire. That'd be
might
great.
take it from 100 million years left to like 90, but I think we could. We're going to Mars. I think we need that to fuel it.
Well, you know what? Why don't we just put some solar panels on a Tesla and then launch the next Tesla on the next SpaceX launch? Because he could have done that with his Tesla, thrown a couple solar panels.
Just have a long wire trailing it.
That's right. Or at least it could jettison a battery.
And we come out of a clown sleeve the whole time. It's just like endless
imagine
wires.
this. It comes like every 4 years. It comes around Earth, and then it jettisons this battery pack it's been charging. That's like the most dense battery pack the world's ever known. It could power like the U.S. for an entire year because it's gotten like straight sun rays.
And it'll land, and then we'll send it back up there.
Send it back. Oh.
There you go.
Whoa.
I think this is his whole plan all along. Whoa. I think we're cracking.
I know. I couldn't figure out the Solar City stuff before.
There it is.
That's exactly what he's going to go harvest energy in space and bring it back
with his Tesla,
and with his batteries.
Yeah.
Holy shit.
Well, I think we cracked something. I think we gave the audience a lot to think about.
I think so. I hope so.
CryptoKitties to sustainability to what's Elon Musk really up to.
Yeah. Sun harvesting.
Harvesting. Solar. Yeah. It's all in the name. So, Kroll, thank you so much for coming on.
No, it's my pleasure. Thanks, Brett.
It's been great, man. Thank you. Thank you for listening to the Style is Free podcast. Shout out to Kroll for coming over and speaking with us. I hope you all learned as much as I did about CryptoKitties, cryptocurrencies, and the sustainability issues with blockchain technology. Until next time, friends, I'm your host, Brett Leibowitz.